A man can see a locomotive coming down the tracks for a mile. He knows it is coming. He can hear the whistle, feel the ground tremble. Yet he stands there, frozen, until it is too late. The top of a bull market sends the same signals. They are just as clear, just as loud, and just as deadly. The public hears the noise, but they mistake the roar of the approaching bear for the cheers of the bull. They think the trembling ground is a sign of strength, when it is in fact the final tremor before the collapse. The great fortunes are not made by buying at the bottom and selling at the top. That is a fool's fantasy. They are made by identifying the great trend and staying with it. But all trends, no matter how powerful, eventually end. My greatest successes came not from brilliant entries, but from recognizing the unmistakable signs that the party was over and leaving before the house burned down. Selling out your line of stocks is the most difficult thing a speculator must do. It is easy to be a bull in a bull market. It is another thing entirely to recognize when that market has run its course. The average man cannot do it. He is blinded by hope, and the paper profits in his account. He listens to the news, to the boardroom gossip, to his own greed. He does not listen to the one thing that tells the truth, the tape itself. The tape, or your modern price and volume chart, is the final arbiter. It has no agenda, no hope, no fear. It simply records the facts. And at a market top, the facts it records are the 4 clear, unmistakable signs of distribution. These are the signals that the great inside interests, the men who accumulate a stock quietly at the bottom, are now feeding their massive lines out to the public. They are not theories. They are fingerprints left at the scene of the crime before the crime is even reported. Your job is not to predict the top. It is to recognize these signs and act on them without hesitation. For if you wait for the locomotive to be upon you, it will be too late to step aside. The first and most obvious sign is motion without progress. Imagine an automobile with its wheels spinning furiously in the mud. The engine roars, smoke pours from the exhaust, but the car sinks deeper. This is what a stock looks like at its absolute top. The public sees the spinning wheels, the enormous volume, and they mistake it for power. They hear the roar of the engine and think the car is about to rocket forward. The professional, however, sees the truth. The car is stuck. It is expending maximum energy for zero forward movement. This is called churning. On the tape, it is the signature of large-scale distribution. A stock that has been rising for months on an orderly increase in volume will suddenly begin to trade in massive, unprecedented amounts. A stock that formerly traded 50,000 shares a day might now trade 500,000 shares. The newspapers will trumpet this as a sign of incredible public interest. The boardroom will issue statements about a bright future. The public, whipped into a frenzy, will rush in to buy. Yet at the end of the day, after all that sound and fury, the price is unchanged. Or perhaps it is down 1/8, or it rallies a point in the morning only to close at the low of the day. This is the work of the composite operator, the great inside interests. They cannot simply dump 1,000,000 shares on the market at once. That would break the price and cause a panic. They must sell it skillfully. They must feed it out to the public on a scale, selling only when there is a market to absorb it. And the top of a bull market is the greatest market for stock they will ever find. They support the stock on declines to inspire confidence, but on every rally, they feed out more of their line. They sell 10,000 shares, then 20,000, then 50,000. The public's buying is enormous, but the insider's selling is a fire hose that extinguishes every rally. The stock is simply unable to make progress. It is hitting a ceiling of supply that is invisible to the amateur, but as solid as a wall of granite. I saw this in my bucket shop days, even as a boy. A stock would be active and strong, the talk of the town. But on the old ticker tape, the predecessor to your modern scrolling charts, I would see the pattern. Buy, 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 and the price would tick up. Then a single massive print would appear, and the price would stop dead. More buying would come in, but the big seller was always there, waiting, patiently feeding shares into every sign of strength. The stock was being held in place while the insiders got out. It was a danger signal of the highest order. This is not a guessing game. It is a matter of simple arithmetic. If 500,000 shares trade and the price does not advance, it means that for every share that was bought, a share was sold. The immense buying power of the public was met with an equally immense selling pressure. Now ask yourself, who is selling at the all-time highs after a stock has already quadrupled? It is not the public. The public is euphoric. They are buying more. The sellers are the ones who are satisfied. They are the ones who bought it much lower and have decided that the price is now high enough. They are the smart money, and you must follow their lead, not their instructions. They will tell you to buy, but their actions on the tape, their incessant selling, tell you the real story. The rule is this: volume must confirm the price. In an uptrend, rising volume should lead to rising prices. When you see volume reach a deafening crescendo while the price goes nowhere, the trend is over. It is the final transfer of ownership from strong hands to weak hands. The insiders are selling their holdings to the hopeful public. Do not be part of that public. When a stock stops responding to enormous buying pressure, it is finished. Sell your position. Do not wait for a reason. The churning itself is the reason. It is the locomotive's whistle, and you must get off the tracks. The second sign that the end is near is when the generals begin to fall. A bull market is an army on the march. It is led by a small group of high-quality, powerful stocks, the market leaders. These are the stocks that move first, move fastest, and advance the furthest. They are the generals, and the rest of the market are the soldiers. As long as the generals are leading the charge, the army advances. But when the generals stop advancing, or worse, when they begin to retreat, the morale of the army is broken. The battle is lost, even if the soldiers on the front lines have not yet realized it. During every great bull market, I kept my focus on the leaders of the key industry groups. In one era, it was the railroads. In another, it was the steels. In another, the motors. The names change, but the principle is eternal. The health of the entire market rests on the strength of its leaders. When these bellwether stocks, after a long and sustained advance, suddenly stop making new highs, it is time to pay very close attention. The first sign of trouble is when a leader attempts to make a new high and fails. It rallies up to its old peak and then turns back. A week later it may try again, but the rally is weaker. This is a sign of exhaustion. The buying power that carried it for months is beginning to dry up. Then comes the more serious signal. The leader not only fails to make a new high, but it then breaks below a key level of support. It violates its trend. While this is happening, the public is often distracted. They see that the broad market averages are still holding up. This is because after the leaders top out, there is often a final, frantic phase where the public rotates its money into the lower quality, cheaper stocks that have not yet moved. They think they are being clever, buying the laggards that are due for a move. They are mistaken. They are buying the cast-offs, the merchandise that the smart money already rejected. The insiders sell their best stocks first. When those are fully distributed, they will try to create a move in the second-rate issues to unload those as well. This is why the averages can look strong while the true leadership is rotting from within. It is a facade. The army appears to be advancing, but it is only the stragglers at the rear making a final, futile push. The generals are already in retreat. Jesse Livermore consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk $1 of your own capital. To ensure this timeless wisdom translates accurately to the modern, computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. My method was always to identify the leading group and then to trade the one or two strongest stocks within that group. I was never interested in the entire list. I wanted the fastest horse, not the whole stable. By this same logic, when I saw that fastest horse begin to tire and falter, I knew the race was nearing its end. I did not need to wait for the entire stable to collapse. The rule is this: watch the leaders. The fate of the market is written in their price action. Do not be fooled by strength in laggard stocks. It is a sign of desperation, not health. When the strongest stocks in the strongest groups can no longer make new highs and begin to violate their uptrends, the bull market is on its last legs. Sell your positions starting with the leaders that have shown the first sign of weakness. A market without leadership is an army without generals, and it is destined for a rout. The third and perhaps most subtle sign of a top is when the market refuses to respond to bullish news. In a healthy bull market, good news acts as fuel. A positive earnings report, a new discovery, a large government contract. Any of these will be met with a sharp and sustained rise in price. The market is buoyant, it wants to go up, and it uses the good news as a pretext. But at the top, the character of the market changes. It becomes heavy, waterlogged. The same piece of good news that would have sent a stock up 10 points a few months earlier now causes barely a ripple. The stock might open higher, but by the end of the day it has given back all its gains and closed unchanged. This is a very serious danger signal. It tells you that the stock is now in weak hands. During the accumulation phase and the subsequent markup, the stock was held by strong hands, the insiders, the patient professionals. They would not sell on good news, they would buy more, or at least hold for higher prices. But after a long advance, these strong hands have been distributing their shares to the public. Now, the stock is held by weak hands, the emotional, uninformed public who bought near the top. They are nervous. They are hoping for one last pop to sell into. When the good news hits, they see their chance. But so does the last of the inside holders. The buying that comes in on the news is met by a flood of selling from everyone who is now desperate to get out. The supply overwhelms the demand and the stock stalls. The most bearish signal of all is when a stock actually declines on good news. The company might report the best earnings in its history and the stock drops 5 points. To the amateur, this makes no sense. He will complain that the market is irrational. He is wrong. The market is perfectly rational. It is telling him a very simple story. The news is already discounted. Everyone who knew the news was coming has already bought the stock. The rise in the months leading up to the announcement was the market pricing in the good news. The announcement itself is the climax. There are no buyers left. The stock has been fully distributed, and now, with no more good news on the horizon, those who bought late are beginning to realize they are trapped. They start to sell, and with no large buyers left to support the price, it quickly gives way. I learned early on to distrust the news and to trust the tape. A man in a brokerage office would read a piece of good news in the paper and rush to buy the stock, only to find that the stock had been rallying for weeks and was now beginning to fall. He was always late. The real news is not what is printed in the paper. It is how the stock responds to what is printed in the paper. If the response is weak or negative, the game is up. The path of least resistance has changed. The rule is absolute. The reaction is more important than the action. A bull market must act bullishly. When it ceases to respond to bullish information, its vitality is gone. It is an empty shell. Sell the stock. Sell it without hesitation. The market is telling you that all the buyers have bought and all that remains are the sellers. The fourth and final sign of distribution is a dramatic expansion in volatility. A healthy uptrend is orderly. It is a staircase, not a roller coaster. There are advances followed by small, quiet pullbacks, then another advance to new highs. The daily ranges are reasonable. But at a market top, this orderly character disappears. It is replaced by wild, violent, and erratic price swings. The market will open up 3%, only to reverse and close down 2%. The next day, it might do the opposite. These are not signs of health. They are the convulsions of a market in its final stages. This volatility is a direct result of the great conflict taking place. The insiders are trying to sell, and the public is still trying to buy. This creates a battleground. One day, the public's enthusiasm wins and the market shoots up. The next day, a wave of institutional selling hits and the market plunges. This kind of action is designed to confuse and frustrate everyone. It is a shakeout on a grand scale. The violent swings stop out the shorts who are trying to anticipate the decline, and they panic the bulls who are holding on for more gains. The professional speculator, seeing this, does neither. He stands aside. He recognizes that the easy money has been made. The trend is no longer clear. The market is now a dangerous, two-sided affair. This is no place to have your capital at risk. You must remember that your purpose in the market is not to seek excitement. It is to seek profits from a clear and defined trend. When that trend dissolves into chaos, your job is to move to the sidelines and preserve your capital. The public loves the volatility. They see the big swings as an opportunity for fast profits. They are gamblers throwing their money on the table during a saloon brawl. They will be carried out financially. The professional knows that this is the market's way of cleaning house before the real move begins. And that real move will be down. The widening price swings are the tremors. They are a warning that the underlying structure of the market has become unstable. The foundation is cracking. Soon the entire edifice will come down. I learned that in such markets the only winning move is not to play. I would sell my positions and go on vacation. I would go fishing. I would do anything to remove myself from the temptation to trade in a market that had lost its reason. A speculator must have the courage to sit on his hands and do nothing when the conditions are not right. And a market top, with its violent and unpredictable swings, is the definition of conditions that are not right. The rule is this: orderly trends make you money. Volatile chop takes it away. When the daily price ranges of the market leaders begin to expand dramatically, and the market starts making sharp moves in both directions without making any net upward progress, you are in the distribution zone. This is not an opportunity. It is a warning. Reduce your exposure, tighten your stops, or better yet, sell everything and wait in cash. The market is signaling that the period of low-risk advance is over. Protect your winnings and wait for the next clear opportunity. The brawl will eventually end, and a new clear trend will emerge from the wreckage. That is when you will return. These four signs: churning volume, faltering leaders, a bearish reaction to bullish news, and expanding volatility, are the handwriting on the wall. They are the market's way of telling you that the primary trend is changing. They do not appear overnight. Distribution is a process that can take weeks or even months. But the signs will be there for anyone who is willing to look at the tape objectively, without hope and without fear. Your job is to train yourself to see them. Do not argue with them. Do not hope they will go away. Do not listen to the boardroom optimists or the television pundits who tell you that everything is fine. The price action is the only truth. The moment you see these patterns of distribution emerge, you must begin to act, not by shorting. It is often still too early for that, but by selling, by methodically and unemotionally liquidating the positions you have so patiently held during the bull market. Your goal is not to sell the top tick. A man who tries to do that will lose his fortune. Your goal is to sell in a timely manner when the market itself tells you the good times are over. Selling a bit too early is an infinitely smaller error than selling much too late. The former costs you a little extra profit. The latter costs you your entire bankroll. Protect your capital. That is the first and the last commandment of speculation. If you have your capital, you have a future. If you lose it, you are out of the game. Heed the warnings. Recognize the signs of distribution. And when the locomotive is coming, have the good sense to step off the tracks.